Welcome to today's Explainer. I am absolutely thrilled you're here because today we're going to solve a massive financial mystery. Imagine you walk up to a business owner and ask them a seemingly simple question. Did this business actually make money? Now, you might think you could figure that out just by glancing at their bank account, right? Well, actually, wrong. The bank account tells you almost nothing about how a business is truly performing. To find the real answer, you need a very specific document. It's essentially a financial report card that tracks exactly how money flows in and out over time. So let's dive right into this. Picture this. A company makes $1 million in sales, so why did it only actually earn $80,000? It is incredibly easy to assume that strong sales automatically equal massive wealth. I mean, if $1 million flows in the front door, the owner's got to be a millionaire, right? Well, not exactly. That assumption is what we call the revenue illusion. To decode this dramatic drop from $1 million all the way down to 80 grand, we need the ultimate decoder ring, the income statement. By the end of this explainer, you're going to know how to read it exactly like a seasoned investor. So, let's start at the very beginning with this revenue illusion. Every business journey starts at the top of a financial waterfall. Everything starts with revenue. Let's ground this with a simple, everyday example. Imagine we're running a local coffee shop. And let's say this shop sells 5,000 cups of coffee at $5 each. Do the math, and our revenue equals exactly $25,000. This is what's known as the top line, because quite literally, it's the very first number sitting at the top of an income statement. And hey, it sounds incredibly exciting, but we have to remember, revenue is absolutely not profit. There are a whole lot of bills to pay before anyone gets to pop the champagne. Because right away, we run into our first major expense, which is the cost of goods sold. This is the first unavoidable cut in our waterfall. Before paying rent or literally anything else, the shop has to pay for the physical things it just handed over to the customer. Accountants call this COGS, or cost of goods sold. You can't just manifest coffee out of thin air, right? To make those 5,000 cups, they had to buy coffee beans, milk, sugar, the physical cups themselves, and those little plastic lids. These are the direct, inescapable costs required to make your specific product. For our coffee shop example, let's suppose the total cost for all those beans, milk, cups, and lids equals $10,000. So we take our really exciting top-line revenue of 25 grand, immediately subtract this 10 grand for cost of goods sold, and watch our pool of money dramatically shrink. We are now left with $15,000. The crucial point here is that this new, much smaller number gets its own special name in the finance world. It's called gross profit. It is the profit a company makes after deducting the direct costs of making the product, but before any of the everyday operations are even factored in. We've dropped from 25 grand to 15 grand, and honestly, we're just getting started. That brings us down to the everyday operating expenses. We have our gross profit, sure, but a coffee shop doesn't run itself. You've got to pay the everyday bills just to keep the lights on and the doors open. The shop pays rent for the building, salaries for those hardworking baristas, and electricity to run the espresso machines. Throw in some marketing to bring in locals, internet for the registers, and insurance to protect the business. Every single one of these items represents a slow, steady bleed from our remaining funds. Let's group all of those everyday business expenses together. Suppose the rent, salaries, utilities, and all the rest total up to $9,000 for this period. We now have to take our $15,000 gross profit and chop off this $9,000 chunk. Subtracting those operating expenses leaves us with a new milestone number, $6,000. This 6 grand is what we call the operating income. It represents the profit generated specifically from normal day-to-day business operations. But wait, don't celebrate yet. We still aren't at the finish line. We still have to deal with taxes, interest, and other miscellaneous costs. Yep, we've reached the final hurdle. Even after paying for the beans and the baristas, the banks and the government still want their cut. Businesses frequently have to pay interest on loans, like, say, if the shop financed those super expensive espresso machines. Then, of course, there are taxes owed to Uncle Sam, alongside just random other non-operating costs that inevitably pop up outside of the normal day-to-day operations. Let's say these final financial obligations total $2,000. We have to deduct this $2,000 chunk right out of our shrinking pile of $6,000 in operating income. The suspense is definitely building. What is actually left over? Which brings us to the true bottom line. This is the most important reveal of the entire explainer, what the business owner actually gets to keep after the entire financial waterfall has cascaded down. Enter net income. This is famously known as the bottom line because, well, it is literally the last line on the income statement. It's the final profit after every single expense. The beans, the rent, the taxes, the interest is completely paid off. This is the exact number investors watch the closest. If this number is positive, you earned money. If it's negative, you lost money absolutely regardless of how stellar your initial sales were. So for our coffee shop, the final net income is $4,000. Take a moment to really think about that journey. We started with a massive, exciting $25,000 in top-line sales. But after COGS, operating expenses, taxes, and interest, it dramatically cascaded all the way down to just $4,000 in real, actual profit.
Now that we've seen it in action, we can read the complete story.
Because once you understand this flow, you can read the story of almost any business. Let's look at a slightly larger company, just to prove it. Watch how fast we can walk through this full 5-number structure. They start with $100,000 in revenue, subtract $40,000 for the physical goods, that's COGS, leaving a gross profit of $60,000. Next, they pay $35,000 for everyday operating expenses, bringing operating income down to $25,000. Finally, $8,000 goes to taxes and interest, leaving a net income of $17,000. That right there is the complete, uninterrupted journey from sales to profit. An income statement lays all of this out beautifully. The visual contrast here is honestly dramatic, and it perfectly illustrates the harsh reality of business finance. Notice how massive that top-line revenue is at $100,000. It's huge. But now compare it to the tiny net income sitting at just $17,000. That stark difference is exactly why you can never, ever judge a business's health solely by how much cash flows in the front door. So, if there is one ultimate takeaway to lock into your memory today, it's the profound difference between these two metrics. Revenue, the top line, gets all the attention. It gets the flashy headlines, it sounds amazing at parties, but net income, the bottom line, tells the real financial story. The income statement gives you that complete narrative, proving once and for all that revenue absolutely does not equal profit. Which leaves us with this final thought. The next time you're reading the news or chatting with someone and you hear that a company made millions of dollars in revenue, I want you to pause. Remember this explainer and ask yourself one simple provocative question. Sure, they sold a lot, but how much did they actually keep? Because at the end of the day, that is the only number that truly matters. Thanks for joining me on this deep dive, and keep asking the right questions.